So in September, EPR Properties share price dropped 15%. Today's video, I'm going to give you an update on EPR Properties. So EPR Properties update October 2020, what we will cover. Why has EPR's share price dropped? The historical share price trend, the future outlook for EPR Properties, will it recover or go bust? Key risks for EPR Properties, what I am doing, am I buying, selling, holding, and why? So that's what we're going to go through today. Now, if you're new to this channel, welcome. My name's Andy, and on this channel I like to talk about money and success. If you're interested in making, saving or investing money, please be sure to hit that subscribe button down below, hit the notification bell, and then you'll get notified every time I release a new video. And if you enjoy this video, please remember to give it a thumbs up because that helps the YouTube algorithm, which in turn helps me, and I really do appreciate it. Now, before I start, I do need to say I am not a financial advisor. This is not financial advice. You need to do your own research, analysis and due diligence before investing in stocks or shares or making any investment of any kind. What you do is on you, not on me. There you go. Don't just take advice from some dude making videos on YouTube, including me. Okay, now before I start this video, I would like to ask you, if you invest in EPR Properties, what's your view of the outlook for this company? And why? I'd really be interested to know. Please do let me know in the comments down below because it'd be great to get your opinions on what you think is going to happen with this particular company. Do you think it's going to come back? Do you think it's going to collapse? Do you think the share price is basically going to stay the same? What's your view on when the dividend will return? Do you think it will return this year, next year, 2022? What's your views? I would love to know. Please let me know in the comments down below. With all that said, I have made two analysis videos before about EPR Properties, so I'll put a link to the most recent one up there for you now and in the description down below. That will then link to the previous one, which was the one where they originally cut their dividend, but the stock analysis is the one I will link to above and put the card below too for you as well as. But what I'm doing now is an update really to give you more information and let you see what has changed and why I think the share price has dropped. So let's dive right into the slides now. Why has EPR's share price dropped? Well, rent collections are still low. While customers representing 90% of the company's rent roll have reopened for business, EPR still only managed to collect 35% of its contractual rent in August 2020. Now, while that's bad news, I've got to be honest and say the expectation is that they'll collect over 50% of their rents in September. But we haven't had that released yet, so we don't know if that has actually come to fruition. If it has, obviously, that will be good news, but I don't have that data yet, so this is the data we've got. So this is the news, and that's obviously a part of the reason. The next part of the reason really is that cinemas are in trouble. Many blockbuster releases due for release in 2020 have been delayed until 2021. This has also been compounded by the fact that there's been stay-at-home orders and lockdowns, which are keeping people away from the cinemas. Now, over here in the UK, Cineworld literally has closed. So it's closed until further notice, and on their website, they say, "We can confirm that all Cineworld cinemas across the UK and Ireland were temporarily closed on Friday, October the 9th until further notice. This is not a decision we made lightly. We did everything in our power to support safe and sustainable reopenings of our cinemas, and we are so very grateful for our employees who implemented the new protocols, which resulted in lots of positive feedback from customers who visited our cinemas and felt safe. We were very proud of the fact that cinemas were open for 2 months and there was not one COVID case resulting from visiting the cinema. We cannot underscore enough how difficult this decision was. As we have done today, we will do everything we can to save livelihoods and the company. This is an extremely delicate and tricky balance. We continue to work with Cinema Association to ensure we are lobbying government to support our employees and the industry, which has so much cultural significance. We will continue to monitor the situation closely and will communicate our future plans to resume operations once film studios are able to bring their pipeline of major movie releases back to the big screen. We can assure you that once a lineup of movie releases is confirmed, we will be ready to reopen our cinemas as we did in July, with the same safety levels you have already seen, while at the same time keeping the great experience that you are used to getting from us." Now, the key point there is the movie releases back to the big screen. They need the film studios to give them movie releases. Now, View Cinemas, which is another group in the UK, So a quarter of Vue cinemas will shut 3 days a week to slash costs after COVID delays of Hollywood blockbusters, including the new James Bond film. Cinema chain will reduce opening hours at 21 of its 87 UK sites to 4 days a week. The chief executive said they were dealt a body blow by delays of new blockbusters. He said, "Our problem right now is we have no movies." This was a big blow. And quite clearly, a cinema with no movies to show can't open. It's really as simple as that. So they're waiting for the big movie blockbusters to come out. Otherwise, they're saying it's kind of not worth opening. So as a result of that, they've reduced down to 3 days per week. Now, to further compound things, we have this activist investor, Dan Loeb, who's been urging Disney to end the dividend to fund the streaming content. Now, who's Dan Loeb? Dan Loeb is an activist investor. He has a hedge fund, and the hedge fund's Third Point bought into Disney during the second quarter of 2020. One of the key points I want you to pull away from this is he said, "We believe the company should permanently suspend its dividend, redirect capital entirely into content production and acquisition for Disney's direct-to-consumer business centered around Disney+." So that's all fine, unless obviously you're a dividend investor investing in Disney expecting to earn a dividend, because they've already suspended the dividend, and this guy is encouraging them or lobbying them not to bring it back. Now, he has reasons for doing that, and from the share price point of view, that might actually be a good thing for Disney. I don't personally invest in Disney, so on that front, I kind of don't care. But if you're investing in Disney hoping for its dividend to come back, this news may well be of interest to you. Now, Dan Loeb thinks movie theatres are a thing of the past. He also urged to embrace home entertainment as a future rather than movie theatres. Literally, in his letter to them, every Hollywood executive has been able to enjoy first-run movies in the comfort of their home for years, Loeb wrote. "We urge you to democratize this experience and to continue to embrace the future of home entertainment with the utmost urgency in executing the company's digital transformation." He is actually urging Disney not to send things to the cinema earlier than their own Disney Plus channel, because he wants the Disney Plus channel to get the new movies at the same time as the cinemas, basically. And cinemas rely on that advance exposure. Usually it's around 90 days. I believe in his letter he said he wanted to cut it down to 2 weeks at most, or even release them at the same time. That was the notion as I understood it. Now then, without that advantage, if you like, for the movie theatres, that is going to hurt cinemas. There's no shadow of a doubt for it, if his lobbying is successful and Disney do what he says. Because you've got to remember, Disney, it's not just a Disney brand that Disney own. They own a lot of big brands, including Marvel, for example. So all of the big Marvel blockbusters, if they're suddenly, instead of going just to the cinema first for 90 days and then being released on pay-per-view and whatnot, they're going straight to Disney Plus TV, then there's an incentive there for people to not bother going to the cinema to see the new releases and instead just subscribing to the TV services. So I can see his argument. It would increase the value of the Disney Plus service, and Disney does own the content production in that respect. So from that respect, that is a bit of a blow for movie theatres if that actually goes ahead. So that's something you need to consider. Do you think that's a reality, and is he going to be successful? And if Disney do that, will other producers follow suit as well as? And that's something that needs to be taken into consideration. Now, we're going to have a little history lesson here for EPR Properties. Now, note this article is back from literally 2017. That's the key thing to note here, is it's back in 2017. And I just want to point out the company started with 12 theatres, all operated by AMC. Now, 19 years later, which 19 years later then was 2017, it has expanded into recreation and education markets. Entertainment still represents over 50% of its holdings, and at that point in time, the firm owned 147 theatres. Why am I telling you this? Okay, because whilst between 2011 and 2020, EPR did reduce the scale of its top tenants, the top 5 tenants still account for 52% of EPR Properties income. Now then, the biggest tenants are theatres. As you can see, 46% of its income comes from theatres, and the biggest player in that market is AMC Theatres. So what happens to AMC is going to affect EPR. Now, I mentioned that in one of my earlier videos as well. So if you watch my previous videos, you will see what I'm talking about here, because I did go into that in detail then as well. Now, AMC Entertainment could still face an in-court restructuring according to this article. And the key part I really want to pull out from this article is the refinancing July was a scheme that allowed note holders to move ahead of landlords for potential recoveries under a reorganisation plan. For EPR Properties, this is bad news. EPR Properties are AMC's landlord. So if EPR Properties are no longer first in the queue for money coming in the event that AMC was restructured, which means a type of bankruptcy essentially, that's extremely bad for any money that EPR have done a deal with AMC for, which they have. If you look in my previous video, I spoke about that. So watch my previous video, which I linked to earlier and there's a link below for, to find out more about that. But that's the key thing. So we were expecting those rents to come in. If AMC is restructured, those rents may never come in. That clearly is a body blow for EPR if that eventuality happens. Now, obviously, if AMC recovers, it's nothing to worry about. But if it doesn't, then clearly that's going to be bad for EPR. And that's, I would argue, a part of the reason why EPR share price is down. Because this kind of news has been being released during this time period where the share price has been going down. We'll go to share price charts in a moment. AMC theatres will remain open following Cineworld and Regal's temporary shutdown. So in the wake of Cineworld's decision to shutter its UK venues and Regal US theatres, AMC, the #1 exhibitor in the world, will remain open. AMC joins #3 exhibitor Cinemark in staying open during the pandemic, despite Cineworld and Regal's plans to close this Thursday. More than 80% of AMC's US circuit is open, and an even higher share of the chain's international theatres across Europe and the Middle East are open, with more than 90% of its Odeon cinemas groups across Europe and 100% of the chain's locations in the Middle East in operation. In addition, AMC is actively planning to open more of its theatres, especially in New York and California, when authorised to do so by the state and county officials. Now that's an important thing. They've closed where they've been told to close because they're being forced to close, and that's part of the problem. It's not that people don't want to go to theatres, it's that people have been told they're not allowed to go to theatres, or the theatres have been told by the authorities, you must close. And that obviously, you couldn't predict this. You know, if we'd have spoke about this last year in 2019, you couldn't predict this kind of disruption to any kind of business model. And you imagine if you run a business, any kind of business, it doesn't matter what it is, if the government says to you, you must close, you have no choice. You have to close. And at that point in time, you still have your costs going out, no money coming in. That's extremely bad for business. And that's why AMC have the risk of a Chapter 11 bankruptcy, which may or may not happen. It may happen, it may not. I'm not saying it's going to. It's just a possibility from that one article that I mentioned there earlier. So now let's look at the historical share price trend. So first we're going to look at the long-term trend. So this is a maximum chart I could pull up. Now, a few things I want to show here. We had a low in February 2019 of $12.79. It then sat in a range between $37 and $60-ish between March 2015 and December 2015. I know I've done them backwards, apologies for that. But that's the range that it sat in between those dates. Now it had a high of $84.46 in January 2016. Now let's look a little bit shorter term chart now. So the 5-year chart, so the most recent 5 years, you see it basically sat in a range between $55 and $80. All right, it went a little bit over and a little bit under, but not a lot. It was basically in that range between December 2015 and March 2020. Okay, so now let's look at the 1-year share price chart. So it basically sat in a range between $79.50 and $65 from October 2019 until February 2020, as you can see there. Then we had everything blow up with our current crisis, and as a result of that, there were lockdowns and stay-at-home orders and things started to be talked about, and all of a sudden the share price absolutely collapsed down to $12.56. Since then, it's basically sat in a range between $20 and $34 between February 2020 and October 2020. There was a slight breakout where it bumped above that and it went as high as $44, but the general range has been between $20 and $34 per share during that time span. Now the 1 month share price, as you can see, has basically been down. And you'll see there's a couple of quite harsh drops there as well. Now then, that's basically when blockbuster releases have been withheld, if you like, and dates have been put back, and bad news has come out from cinemas. And that's really what has driven that, are those things that we spoke about earlier. And that's really why September was such a bad month. As you can see, September and even so far the start of October has not been particularly great. So what's the future outlook for EPR Properties? Will it recover or will it go bust? This is something you really need to decide for yourself, if I'm quite honest with you. My personal view is I think it will recover over the long run. In the short term, it's extremely uncertain because we don't know what's going to happen with the cinemas and the theatres and with lockdowns and stay-at-home orders in general. If people are allowed to go out, I believe they will. My view is people really want to go out and really want to have experiences, and I think now people value experiences more than they value material items. So I think that's the way it's going. I think a lot of people are into minimalism, but they want experiences. So a lot of the things that EPR Properties offer, which I went through in my earlier videos, I think are things that people really, really want, and probably more so having been locked indoors for such a long period of time, because now people are really going to be wanting to get out. The problem you've got is, are people allowed to get out? Are people going to be too frightened to get out? There'll be certain categories and age groups that will be more frightened than others. However, remember that the majority of people who go to the experiential things are actually younger people. Cinemas, their most popular user is apparently a 15-year-old. That's what I read when I was reading through the research for this. Well, the 15-year-olds are not particularly worried, trust me, okay? They're not the people that are thinking, oh, I must stay at home right now. They're not frightened about this in the slightest little bit. So when they're allowed out, they will be going back to the cinemas. The cinemas will therefore be doing just dandy and should therefore, in my opinion, be able to pay their rent. And if they pay their rent, EPR then does dandy, which means EPR then pays dividends. As soon as EPR pays dividends, the share price goes up. And then as an investor, I see it as a win. So that's all good. But how long is it going to take? There's the key question. And it's really down to the politicians at this stage, I would say, whether we get a vaccine for the virus. If there's a vaccine come along, that may get some confidence. It probably to do partly with reporting. If you notice the way things are reported at the moment, they're reporting how many deaths there are, how many cases there are, rather than pointing out what the survival rates are. If you pointed out there's a 99.99% survival rate, that's an entirely different statistic to be putting on the screens in the TVs in people's houses. If you point out that the average age of people who die is 78 from this particular disease, and then you look at the average age that people die anyway, you're going to start to notice some correlations. And I do think that people will get less worried as a result of that. Now, I'm not saying you shouldn't take precautions. Everyone should be taking precautions for any disease, quite frankly. You don't want to be catching anything. Nothing is good to be catching. But by the same token, there is almost a hysteria that has taken over the world, certainly the political world, and I can understand that because from a political standpoint, it's a hot potato. If you have headlines saying people are getting ill and people are dying in your country, be that America, the UK, Germany, any country, as a political leader, that does not reflect well on you. And it doesn't matter what your political leaning is, that looks very bad. And I also don't think it matters what political leaning you are either, as to you don't want people to die. I don't think there's I hope there's not a political leaning word by they want people to die. But, you know, hopefully everyone would want other humans to be fit, well, healthy, and not die, basically. So that's obviously the issue we have here. Now, I did watch a news report the other day where a lady was comparing COVID to flu. And apparently when flu first came out, it killed something like 55 million people in its first year. And apparently this is how it works. When a new disease is new to humans, it kills a lot of people, and then over time you get herd immunity. Now, and at that point it then becomes, as we have the flu now, you learn to live with it and manage it, and the remaining population, so to speak, either have that immunity or are well enough to cope with it. And in addition to that, drugs are developed to make things better. Now, all of those things are obviously going to happen over time. One way or another, it's going to happen. We'll have lockdowns, we'll have stay-at-home orders that will slow it down and potentially extend that period, which from an economic standpoint will make things worse, but it will hopefully save some lives, and that's the whole purpose of it, of course. But you have to wait and see, or we have to wait and see how long. Now, from an investor point of view, you actually want that to be shortened. You want to get to a flattening of the curve and a low level of issues, if you like, with the disease, with COVID, as sooner rather than later. Because the sooner you get to that low level of issues, the sooner we'll return to what normality looked like before, and the better. Obviously, we have other things to contend with. We've got, if Disney, for example, does as Dan Loeb would like and actually stops releasing its movies to the cinemas, that's going to be a problem for the cinemas and the movie theatres, especially if other companies follow trend. I don't think he's going to be successful. I really hope he's not successful, but I don't know. I don't have a crystal ball. I can't tell you the future for sure. All I can do is report on what he's attempting to do and what I've read so far. I would like to think there's always going to be blockbuster movies. Personally, I like going to the cinema. You can see from my hair, I am not a 15-year-old. So if I like going to the cinema, I'm certain that teenagers are still going to like going to the cinema. Sure, there's going to be more people watching things at home as well as. But I don't think that's going to stop people from going to the cinema. I think you can't, there's something special about that whole experience of going to the cinema, having your popcorn and watching the movies on the very big screen. And sure, home TVs have got bigger and bigger, but it doesn't compare. It's not the same as going out with your friends. It's not the same. And also with EPR Properties, as I said, I would like them to, as I said, you don't know I've said this yet. I'm about to say this. I'm getting ahead of myself. I'm going to tell you in a minute. Now, is it likely to go bust? Now, I covered that in a previous video. As I said, it's got, I think, 48 months worth of cash in the bank to be able to pay its bills, if you like, without any worry, without any money coming in. So we know from the previous financial statement, which I reviewed in that analysis I did previously, it's good for nearly 4 years. However, there are still key risks, and those are what I'm going to go through with you next. So the key risks for EPR Properties. So its key risks are that movie theatres go out of business. Remember, if movie theatres go out of business, that makes up almost 50% of the income for EPR Properties. So then you have to ask, what happens next? Do those buildings get repurposed and change into something else? That would be expensive. That's going to cost EPR money. That's not good. And what you're going to change them into? Or will new theatre companies come in which case all you've got to worry about is the lost rent from this time period, in which case, if I'm honest, that's probably not so bad for EPR Properties. They could probably cope with that. And I think it's also more likely because, as I said, my view is that theatres are something that will continue long into the future. I think people want experiences, and I think people like watching things on the big screen. Personally, that's my view. Now, if you disagree with that view, then you probably don't want to be investing in EPR Properties, certainly not as it's structured at the moment, with so much of its portfolio in movie theatres and cinemas. Other experiential activities are forced to be closed. Quite clearly, if the other things that it owns are forced to be closed, its theme parks, its golfing and ski resorts and so on, if they're forced to be closed, quite clearly that's going to be very, very bad for EPR Properties. Now, as I understand it, the majority of those are now back open again. So that side has, for now at least, been allayed, but it's down to political will and what the politicians decide. It's not really down to normal economic forces. The people, I believe, would be going out given the choice to go out. And that's the key thing. So we're waiting for the political will to change rather than what the people change. If this was simply down to economics and what humans want to do, humans are a social beast, if you like. They like to go out with other people, they like to spend time with other people, and they like to experience new, different and exciting things. People like to go to theme parks, they like to go on rides, they like to try new things, and they like to watch movies on a big cinema screen. People like doing those things. People, trust me, people will forever go on dates. It's not going to stop, but it is going to stop whilst they're told they're not allowed to do it. So we need them to be allowed to do these things. Now, at the moment they are, and that's why so many of these things are open. But imagine another lockdown, another forced stay-at-home orders. That's going to cause problems for this industry if that happens. If things do not recover before debts need to be repaid, you can see on the graph on the right here, it's got 750 million in its unsecured credit facility due for repayment in 2022. Now, we're 2 years away from that, but if in 2 years' time this is still going on, I see that as a big problem for EPR Properties, because they're going to need to repay that money and they don't have that amount of money on their balance sheet to repay it. They're going to need to push that down the road. And if their credit rating is downgraded and they have to take it on again at a higher interest rate, quite clearly that's going to be very bad for EPR Properties, and it'll be bad for their cash flow, which will in turn be bad for their dividends, which will in turn be bad for their share price, and obviously bad for the investors such as myself, and if you're an investor in EPR Properties, you as well. So what am I doing? Am I buying, selling, holding, and why? So my thoughts. No dividend is likely in the short term, and in fact I don't want them to pay a dividend in the short term. I want them to continue to preserve cash. As soon as the dividend does return, the share price will shoot up. That's my view. I genuinely think as soon as that dividend comes back, the share price is going to rocket. I believe people like to have experiences, so believe in the long term for EPR Properties. That's my view. I would like to see it continue to diversify away from cinemas and movie theatres, because I do see that as too heavy. I think 46% in any one industry is too much. I want to see that reduced. I want to see it go into other things. I'd like to see it increase, maybe it's casinos, in other leisure things, and just keep it increasing so that gradually the cinemas gets diluted to be a smaller percentage, because I really don't like that a company like AMC theatres can have such a big impact on the landlord, EPR Properties. Admittedly, I don't think it'll make it go broke, but it's not good, and you've seen that in the share price, how much damage it's done, certainly in the short term. And I do see it as a good potential comeback play, although, as we've clearly established, not one without risk. So what are my investing plans with this? Well, obviously the shares I hold at the moment, I'm going to continue to hold. I'll possibly buy some more at the current share price. Personally, I think this $24, $25 per share price is really good value for a long-term play, which is what I do, you'll see in a moment. If it drops below $20 and the fundamentals don't change, and that's key, so if it drops below $20 per share and the fundamentals don't change, I will certainly be buying more. I have already bought more. If you look in I've announced what shares I've been buying in a previous video, so you can see what I was buying and why. Personally, it's not a massive part of my portfolio, so I am limiting the risk. I'm not using this as my main portfolio play. It's not a massive percentage of my portfolio, but I am a fairly aggressive investor, and I do think this will be good for the long term. So I'm fairly bullish on it, if I'm honest with you, even though all the news is bad. And in fact, the old saying, when others are fearful, be greedy. Now, people are definitely fearful. Right now, everyone's looking at, and the news, as you can see, is very much looking like theatres are closing, cinemas are going out of business, they're going bankrupt, the movies are all going to go in-house, people are going to watch Netflix, and no one's ever going to leave the home again. Now, if you believe that that's going to be the case, this is not the investment for you. Me, I don't believe that that's going to be the case. Personally, I think people are dying to get out. People really, that's probably a bad choice of words. People really want to get out right now. They are bored to death of being stuck at home in front of the TV, and they want to get out. And I genuinely believe that. So I think as soon as the blockbuster movies are released in 2021 and the cinemas are reopened, especially if there's a vaccine brought in as well as, or if, let's say, herd immunity happens to get hit in the meantime, say we have a really bad COVID winter and actually loads of people get ill, but as a result of that, over say 60% of the population have had it. Once that happens, you get the herd immunity thing in place, and now all of a sudden it's less of a risk, and then they need to do less on the lockdown fronts, and things will be opening up more naturally, because there'll be no reason, as I understand it, to keep locking things down. Now, if that's the case, 2021 should start to be better and everything should be rosy. But we need that to actually happen. That's what I'm predicting. If I'm wrong and by 2022 it's not happened, remember the risk. They've got all that debt to repay in 2022, and if they haven't had the income to pay it, that's going to be very bad for EPR Properties, and at that point the share price is going to collapse even further. I don't think they'll go out of business, but I do think we're looking bad things happening for EPR Properties then. And so obviously that's not an outcome I want to risk a large portion of my portfolio for, which is why, exactly why, I'm only putting a limited amount of my portfolio into this. However, I do expect fully that over the next 5 and certainly over the next 20 years, that portion of the portfolio is going to do really, really well. If I didn't, I wouldn't have bought them, and I wouldn't continue to hold them, and I wouldn't continue to buy them. So that's my view on that. Now then, I intend to hold for many years, 20 years plus. So you need to decide that as well. If you're only investing in these for a year, this is not a good share to buy. I wouldn't suggest this is a good share to buy for a year. I haven't made a slide for this, but I can tell you the analysts' 1 year forecast for this range between $41 per share, which is a good big increase on the current share price, but they go as low as $16 per share, I believe it was, which would be a loss. So that's the 1 year forecast. So you do need to bear that in mind and think if you're buying these on a short-term play, it's probably not for you. If you're buying these for dividends in the short term, it's definitely not for you. If, however, you're aware of the risks that we've gone through and you do your own research, then it could well be for you if you're holding for the long term. Because in the long run, my view is I expect them to recover. I expect good capital growth. I expect the dividend to return over the long term, and then I expect that to cause even more capital growth. And I expect certainly in 5-10 years time, this will be an absolutely stonking dividend company, and people will be looking back at the price we're buying it today and going, wow, you could buy it that cheap. And that's obviously the position I want to be in. If you happen to be interested in dividend stocks and stocks that have not suspended their dividend and have really coped well during 2020 and this current crisis, then please do check out my previous video, which I've made of all the monthly dividend stocks that have not suspended their dividends during 2020. I really hope you've enjoyed this video. Thank you so much for watching, and bye bye.